Warren Buffett is worth over $100 billion. But here's something that will completely change how you think about his success. Buffett made 99% of his net worth after his 50th birthday. Not in his 20s when he was hungry and aggressive, not in his 30s when he was building his reputation, and not even in his 40s when he was already respected on Wall Street. He made nearly all of his fortune after the age most people start thinking about retirement. Warren Buffett didn't get rich because he was the smartest person in the room. He got rich because he stayed in the room longer than everyone else. While others sprinted and burned out, Buffett walked steadily for decades, and those decades turned thousands into millions and millions into billions. This is the story of how one man turned patience into $100 billion. Warren Edward Buffett was born in 1930 in Omaha, Nebraska during the Great Depression. His father was a stockbroker and later a congressman, which gave young Warren early exposure to business and investing. But Buffett wasn't born into extreme wealth. He grew up in a middle-class household in the Midwest, far from the power centers of Wall Street. What made Buffett different wasn't his circumstances, it was his mindset. By age 6, he was buying 6 packs of Coca-Cola from his grandfather's grocery store for 25 cents and selling individual bottles for a nickel each. By age 11, he bought his first stock. By 13, he was filing his own tax returns. He wasn't a prodigy with secret knowledge. He was just a kid who started early and never stopped. Here's why Buffett's story matters to you, whether you're an investor or not. His success isn't built on complexity, insider connections, or genius-level IQ. It's built on principles anyone can understand: patience, consistency, and letting time do most of the work. Buffett himself has said repeatedly that you don't need to be extraordinarily smart to become wealthy. You just need to be disciplined and willing to wait. Today, Buffett runs Berkshire Hathaway, a holding company that owns everything from insurance businesses to railroads to major stakes in companies like Apple and Coca-Cola. But more than his portfolio, what matters is his method. And that method is built entirely on understanding how time transforms small advantages into enormous wealth. In a world obsessed with shortcuts and overnight success, Buffett's philosophy is revolutionary because it actually works. When people hear that Warren Buffett is a billionaire investor, they usually imagine someone glued to a screen, watching stock tickers flash red and green. They picture late nights analyzing complex charts, making bold predictions, buying low, selling high, and repeating that cycle hundreds of times. They think Buffett became rich by being smarter, faster, and more aggressive than everyone else. But that image couldn't be further from the truth. Warren Buffett rarely trades. He doesn't spend his days obsessing over market fluctuations. He doesn't try to predict what's going to happen next week or next month. In fact, Buffett once joked that his ideal holding period for a stock is forever. Think about that. Forever. Not until it goes up 20%, not until he needs the cash. Forever. This is where most people fundamentally misunderstand wealth creation. They think getting rich is about speed, about finding the next hot stock, the next cryptocurrency, the next trend before everyone else does. They think wealth comes from action, from doing more, trading more, moving faster. And because they think that way, they end up exhausted, stressed, and often poorer than when they started. Buffett understood early on that wealth doesn't come from speed. It comes from endurance. The markets reward patience in ways most people never experience because they never stay patient long enough to see it. There's a famous example that illustrates this perfectly. In the early 2000s, Buffett was criticized for not investing in tech stocks during the dot-com boom. Everyone else was getting rich overnight, and Buffett just sat there, doing nothing. Then the bubble burst. Trillions evaporated, companies worth billions went to zero. And Buffett? He was fine. He wasn't trying to get rich quick. He was trying to stay rich long. And that's a game time always wins. Warren Buffett bought his first stock at age 11. That's earlier than most people even think about money seriously. But here's what's important. It's not that he started at 11 that made him a billionaire. It's that he never stopped. Buffett is 95 years old as of 2025. That means he's been actively investing for over 80 years, 8 decades. Most people don't invest for 8 years, let alone 8 decades. And this is where the power of starting early and staying consistent becomes almost unfair. When Buffett bought those first shares at 11, he didn't make life-changing money. In fact, he made a mistake. He bought at $38, watched the price drop, panicked, and sold at $40 for a tiny profit. The stock later shot up to $200. But the real lesson wasn't about picking the right price. It was about staying in the game. Here's a thought experiment that shows why starting early matters so much. Imagine two investors. Investor A starts at age 20 and invests $200 a month until age 30, then stops completely. Investor B waits until age 30 and invests $200 a month until age 65. Assuming both earn a 10% average annual return, who ends up with more? Surprisingly, investor A does, even though they invested for only 10 years versus 35 years. Why? Because those extra 10 years of compounding in the beginning create exponential growth later. Because Buffett started at 11, he gave himself 8 decades to learn, grow, and compound his wealth. By his 20s, he had already accumulated enough capital to make bigger investments. By his 30s, he was running investment partnerships. By his 40s, he controlled Berkshire Hathaway. And by his 50s and beyond, the wealth he'd built began compounding at an incomprehensible scale. Buffett didn't just start early. He stayed consistent, year after year, decade after decade. And that consistency, combined with time, turned a boy from Nebraska into one of the richest people in history. Albert Einstein allegedly called compound interest the eighth wonder of the world. Compounding is the closest thing we have to magic in finance, and Warren Buffett built his entire empire on understanding it better than almost anyone else. But here's what most people miss. Buffett doesn't just compound money, he compounds knowledge, and over 8 decades, both have given him an almost unfair advantage. Let's start with how money compounds. It's simple. You earn returns not just on your original investment, but on all the returns you've already earned. Imagine you invest $10,000 at age 20 and earn 10% per year. By age 30, you'd have about $26,000. By age 50, about $174,000. By age 70, over $1.17 million from a single $10,000 investment. But here's the key. The real growth doesn't happen in the first 20 years. It happens in the later years. It took 30 years to grow from $10,000 to $174,000, but only 10 more years to grow from $174,000 to $452,000. The snowball gets bigger faster the longer it rolls. Warren Buffett's wealth follows this exact pattern. He became a millionaire by age 30, but he didn't become a billionaire until age 56. He didn't reach $10 billion until his early 70s. Most of his wealth was created in the last 2 decades of his life, not because he suddenly got better at investing, but because the compounding he'd set in motion decades earlier finally reached exponential scale. Now here's where it gets really interesting. Buffett also compounds knowledge. He reads for 5 to 6 hours every day, every single day. When asked about success, he once held up papers and said, "Read 500 pages like this every day." That's how knowledge works. It builds up like compound interest. 5 hours a day for 80 years. That's over 146,000 hours of reading. But it's not just volume. The more you know, the faster you learn new things, because new information connects to old information. Patterns emerge. Learning becomes easier and faster the more you've already learned. Just like compound interest, compound knowledge means each new piece of information becomes more valuable because it connects to everything you've learned before. And here's the beautiful synergy. Compounding money and compounding knowledge reinforce each other.
The more Buffett learned, the better his investment decisions. The better his decisions, the more capital he had. That feedback became new knowledge, leading to even better decisions. It's a virtuous cycle running for 8 decades. And here's the best part. Compounding knowledge doesn't require money. You just need curiosity and time.
There's an old investing saying, time in the market beats timing the market. Warren Buffett lives by this principle, and it's one of the reasons he's been so successful while so many others have failed. Timing the market means trying to predict when stocks will go up or down, then buying or selling accordingly. It sounds smart. Buy low, sell high, wait for the dip, get out before the crash. But here's the problem. Nobody can consistently predict the market. Not professionals, not algorithms, and not you. Warren Buffett takes the opposite approach. He doesn't try to time the market, he just stays in it. He buys great businesses at reasonable prices and holds them through ups and downs. He doesn't sell when the market crashes. He doesn't panic when things get volatile, because he knows that over long periods, quality businesses grow in value. Let's look at some data. From 1928 to 2023, the S&P 500 delivered an average annual return of about 10%. But if you missed just the 10 best days in the market during that span, your returns would drop to around 5%. Miss the best 30 days and you'd barely break even. The problem? Those best days often happen right after the worst days. If you're trying to time the market and sitting in cash waiting for calm, you miss the recovery. And the recovery is where the money is made. Buffett experienced this during the 2008 financial crisis. The market collapsed, banks were failing, panic everywhere. And what did Buffett do? He invested. He bought stock in Goldman Sachs and General Electric. He wrote an op-ed titled "Buy American, I Am." People thought he was crazy, but Buffett wasn't trying to time the bottom. He was staying invested in great businesses. Within a few years, those investments paid off massively. This is a mental shift most people struggle with. We want certainty. We want to know what happens next week, next month, next year. But Buffett thinks in decades. He knows that over 10, 20, or 30 years, quality businesses will grow. There will be recessions, there will be crashes, but time smooths out volatility. Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." That's not just clever, it's the truth. Time rewards patience. And Buffett has been patient for 8 decades. Warren Buffett doesn't see himself as someone who buys and sells stocks. He sees himself as someone who buys businesses. And once he buys a business he believes in, he holds it, often for decades, sometimes forever. This philosophy has produced some of the greatest investment returns in history. Let's look at Coca-Cola. Buffett began buying Coca-Cola stock in 1988. At the time, critics said soda consumption was declining, but Buffett saw a brand that had been around for over a century, a product sold in almost every country on Earth, a business with a durable competitive advantage. So he bought in, and he never sold. Today, more than 35 years later, Buffett still owns those shares. Berkshire Hathaway's original investment of about $1.3 billion is now worth over $25 billion. Beyond stock appreciation, Coca-Cola pays dividends. Berkshire now receives over $700 million in dividend income from Coca-Cola every single year. That's more than half the original investment, paid annually just for holding the stock. Then there's American Express. Buffett first invested in the 1960s during a scandal that tanked the stock. Most investors fled. Buffett bought. He saw that the core business, a trusted payment network and brand, was still intact. He still owns American Express today, over 60 years later. The investment has returned thousands of percent. And Apple. Buffett started buying Apple stock in 2016. This surprised people because he'd historically avoided tech stocks. But Apple was different. It wasn't just a tech company. It was a consumer brand with loyal customers, recurring revenue, and a massive ecosystem. Within a few years, Apple became Berkshire's largest holding, worth over $150 billion at its peak. The common thread? Time. Buffett didn't buy Coca-Cola hoping it would go up 20% in 6 months. He bought it believing it would still be a great business in 20 years. This long-term holding strategy eliminates noise. When you're holding for decades, you stop caring about daily price movements. You zoom out. And when you zoom out, you realize that great businesses tend to grow over time, despite short-term setbacks. Buffett also avoids taxes this way. Every time you sell for a profit, you pay capital gains tax. But if you never sell, you never trigger that tax. Your money stays invested, compounding without interruption. Perhaps most importantly, Buffett knows he doesn't need to be perfect. He just needs to be right about a few things and hold them long enough for time to prove him right.
One of the most underrated aspects of Warren Buffett's success is his ability to do nothing. And by nothing, I don't mean he's lazy. I mean he has the discipline to sit still when everyone around him is panicking, buying, selling, and overreacting. In a world that glorifies action, Buffett has mastered inaction. He once said, "The stock market is designed to transfer money from the active to the patient." Most investors lose money not because they pick bad investments, but because they can't stop themselves from doing something. They check portfolios constantly. They react to every headline. They buy when everyone else buys and sell when everyone else sells. And all that activity destroys returns. Buffett does the opposite. He buys high-quality businesses and then nothing. He doesn't trade in and out. He doesn't try to optimize every movement. He just waits. And waiting, it turns out, is incredibly profitable. Consider the 2020 COVID-19 pandemic. In March 2020, the stock market crashed. Fear was everywhere. People were selling everything. Fortunes were disappearing overnight. And Buffett? He did almost nothing. Berkshire made a few moves, but mostly Buffett just sat on his hands. People criticized him. They said he'd lost his touch. But Buffett wasn't scared. He just didn't see anything worth doing. He knew the market would recover eventually. He knew his businesses would survive, so he waited. Within a year, the market fully recovered. Those who sold in panic missed the entire rebound. Buffett didn't. This ability to do nothing is rooted in emotional control. Investing isn't just about intelligence, it's about temperament. You can have genius-level IQ, but if you panic during downturns, you'll lose. Buffett has said that success in investing doesn't require extraordinary intelligence. It requires ordinary intelligence and extraordinary emotional discipline. Doing nothing is also a form of compounding. Every time you sell a stock, you interrupt compounding. You trigger taxes. You have to find something new to buy. You risk making a mistake. But if you do nothing and just hold, compounding continues uninterrupted. Buffett once proposed that every investor should get a punch card with only 20 punches for their lifetime. Each investment decision uses one punch. Those 20 carefully chosen investments, held for decades, would likely outperform thousands of hurried trades. Doing nothing isn't passive, it's strategic. It's a conscious choice to ignore short-term noise and trust the long-term process.
Warren Buffett is often portrayed as a flawless investor, someone who never makes mistakes. But that's not true. Buffett has made plenty of mistakes, some enormous. The difference is that Buffett understands something most people don't. Time heals mistakes if you're patient and don't compound them with more bad decisions. One of Buffett's biggest mistakes was buying Berkshire Hathaway itself. In the 1960s, it was a struggling textile company. Buffett bought it out of spite after a disagreement with management. He later admitted this was terrible. The textile business was dying, and he poured years and capital into trying to save it. He's estimated this mistake cost him tens of billions in opportunity cost. But Buffett didn't panic. He didn't sell and run. Instead, he pivoted. He kept the Berkshire name but gradually shifted the business into insurance and investments. Over time, Berkshire transformed from a failing textile mill into one of the most successful holding companies in history. The mistake didn't disappear, but time and patience turned it into something valuable. Another example is IBM. Buffett bought billions in IBM stock starting in 2011, believing it had a strong moat. But IBM struggled. The stock went nowhere. Buffett eventually admitted he was wrong and sold at a loss. It was a rare public acknowledgement.
But notice what he didn't do. He didn't double down out of ego. He didn't panic and liquidate everything. He calmly reassessed, admitted the error, and moved on. Buffett's philosophy is simple. Mistakes are inevitable, but they don't have to be fatal. If you own a diversified portfolio of high-quality businesses and hold them long enough, the winners will far outweigh the losers. Time allows good decisions to compound while bad decisions fade into irrelevance. This is why patience after a mistake is so powerful. If you're constantly buying and selling, every mistake gets locked in as a loss. But if you're holding long-term, temporary setbacks often recover. Companies go through rough patches, industries face disruption, recessions happen, but great businesses tend to adapt and survive. And if you give them time, they often come back stronger. Buffett also talks about avoiding permanent mistakes, ones that destroy capital beyond recovery, like investing in fraud, taking on excessive debt, or betting everything on a single outcome. He's willing to accept temporary setbacks, but he structures investments so even his worst mistakes can't ruin him. Most people can't tolerate being wrong. They panic, they sell at the bottom. But Buffett sees mistakes as part of the process. He doesn't expect perfection, and that acceptance gives him the emotional stability to stay in the game for decades.
Warren Buffett's story isn't just about one man becoming a billionaire. It's a blueprint for how time, patience, and consistency create wealth. And the best part? You don't need to be a genius, have insider knowledge, or start with millions to apply these principles. Start now, no matter how small. Buffett bought his first stock at 11 with newspaper route money. You don't need thousands. Even $10 or $20 a month invested consistently can grow significantly over decades. The key is to start. Every month you wait is a month of compounding you'll never get back. Think in decades, not days. The market will fluctuate every single day. Companies will have good and bad quarters. None of that matters if you're thinking long-term. Ask yourself, where do I want to be in 20 or 30 years? Then make decisions that serve that timeline. Ignore the noise. Zoom out. Let compounding do the work. You don't need to pick the perfect stock or time the market perfectly. You just need to stay invested long enough for compounding to take over. Small, consistent gains over decades turn into life-changing wealth, but you have to give it time. Own quality and hold it. Buffett doesn't chase trends. He buys great businesses and holds them for years or decades. You can do the same with index funds, dividend stocks, or solid companies. Find quality and be patient. Do less, not more. Most people hurt returns by trading too much, but activity doesn't equal results. Often, the best move is to do nothing. Buy quality, hold it, and let time work. Keep learning. Buffett reads 5 to 6 hours daily. You don't need to match that, but commit to lifelong learning. Read books, study businesses, understand financial principles. Knowledge compounds like money. Stay calm during downturns. The market will crash. It always does. When it happens, don't panic. If you own quality investments, they'll recover. Time heals volatility. The people who stay calm win. Avoid permanent mistakes. Don't invest money you need for rent. Don't take on excessive debt. Don't bet everything on one investment. Protect yourself from ruin, and time will take care of the rest. Be patient with yourself. Building wealth takes time. You won't see dramatic results in the first year or even 5 years, but if you stay consistent and trust the process, the results will come. These principles work whether you're investing $50 a month or $50,000. Time is the great equalizer. Warren Buffett once said, "Someone is sitting in the shade today because someone planted a tree a long time ago." You can't go back and plant that tree 10 years ago, but you can plant it today. And 10 years from now, you'll be sitting in the shade grateful that you started. The clock is already ticking. Time doesn't care about your excuses. It just moves forward. The only question is whether you're using it or wasting it. So start now, because the best time to plant a tree was 20 years ago, but the second best time is today. If this video changed the way you think about wealth, time, and patience, hit that like button. It helps more people discover these ideas. If you want more breakdowns of timeless principles from the world's most successful investors and thinkers, subscribe to the channel.
We're building a library of deep content that cuts through the noise and focuses on what actually works. Drop a comment below. Which lesson resonated with you the most? Was it compounding, doing nothing as a strategy, or that 99% of his wealth came after age 50? I read every comment and would love to hear your thoughts.